You're listening to All Things Investing, the podcast that makes money talk simple, smart, and actionable. Whether you're just getting started or leveling up your portfolio, we've got you covered with tips, strategies, and no-fluff advice. Let's grow your wealth, one episode at a time.
Did you know that if you ask a standard off-the-shelf AI chatbot a financial question today, there's like a 35% chance it will just completely hallucinate the answer?
Yeah, it is it's honestly a terrifying statistic. I mean, it will confidently tell you a company's revenue doubled over the last quarter, complete with like bullet points and this super cheerful tone, when in reality that company just filed for bankruptcy.
Oh, wow. Yeah, which is exactly why we're doing this deep dive today.
Mm-hmm.
We are looking at this massive stack of sources like tech breakdowns by Barebone Research, platform guides from Dubb and eToro, market analyses, and it's all centering on the exploding world of AI investing.
Yeah, the AI investing boom.
Right. And honestly, that 35% hallucination rate is, well, it's the perfect place to start because it really establishes the stakes here for you, the listener.
Absolutely.
Because if you're a beginner or honestly even an intermediate investor, the App Store right now is just a total minefield.
Oh, it's wild. You type in investing and you are just bombarded with these platforms.
Yeah, promising that artificial intelligence is going to like effortlessly build your wealth while you sleep.
Right, because the marketing is incredibly seductive.
Yeah.
It really is. The idea that you can just tap a button, let a supercomputer do all the heavy lifting, and go enjoy your weekend without needing a finance degree.
Exactly.
It completely preys on the natural overwhelm most people feel when they look at the stock market.
Which makes sense. I mean,
What?
It is overwhelming. So our mission for this deep dive is to be your shortcut through all that noise.
Yes.
We are going to separate the genuinely useful tools from the absolute marketing fluff.
Oh.
But before we even get to the specific apps, we have to clear up this foundational misunderstanding that our sources highlight literally immediately.
Yeah, the big categorization problem.
Right. Beginners tend to lump AI investing into one single category, like it's all just one thing. But we're actually talking about two vastly different ecosystems here.
Vastly different.
Robo-advisors versus AI research tools.
Conflating those two is, well, it's the first major trap. If you don't know what job you're actually hiring the software to do, you're going to end up frustrated.
Or worse, broke.
Yeah, exactly. Or broke, because you have platforms like Wealthfront and Betterment in one corner, right?
Mm-hmm.
And then platforms like Danelfin, Fiscal.ai, and Barebone AI in the totally opposite corner.
So let's use an analogy to map this out for everyone because the terminology gets really dense quickly.
Good idea.
Think of a robo-advisor, so your Wealthfronts and Betterments, like a self-driving car on a closed track.
Okay, a closed track.
Right. You tell the software your destination, you lock the doors, sit in the back seat, and it does the driving for you.
Right.
It stays strictly within a specific set of parameters that you agreed upon when you got in.
That closed track detail is key, though. It is not going off-roading.
No off-roading allowed. None. Now, an AI research tool, on the other hand, is like having the world's most advanced GPS system mounted on your dashboard. It will calculate the probabilities of a faster route. It'll warn you about traffic pileups. It might even, tell you the price of gas at the next 3 exits. But your hands have to stay firmly on the steering wheel. You are the one pressing the gas pedal. You are making the turns.
I love that framing so much. The robo-advisor automates the execution of a portfolio. Like, it actually moves the money.
Right.
Whereas the AI research tool automates the really tedious work of discovering and analyzing data. But it leaves the execution entirely up to you.
Which is a huge difference.
Huge. And most beginners download a heavy-duty research terminal thinking, oh, it's going to manage my money for me. Or they open a robo-advisor expecting it to give them, like, hot stock tips.
Yeah, and neither of those things are going to happen.
Yeah.
So keeping that GPS versus self-driving car distinction in mind, let's start at the very beginning of the investor journey.
Let's do it.
Because before anyone cares about algorithms or market analysis, there is a massive, psychological barrier that stops people from investing at all.
Oh, the paralysis of the starting line. It's so real.
Yeah.
Behavioral economics actually tells us that humans are incredibly bad at prioritizing long-term abstract benefits over short-term tangible costs.
Right, the I want it now problem.
Exactly. When you tell someone they need to invest for 30 years in the future, their brain just hears, I have to give up my money today for some hypothetical scenario I can't even picture.
Combine that with the classic excuse, right? We all know it. I just don't have enough money to make this worth it. I need to save up like $5,000 or $10,000 before I can even justify opening a brokerage account.
Which is mathematically flawed, but psychologically very, very real.
Totally real.
And this is where the entry-level apps really prove their worth, because they attack that exact friction point. They basically bypass the whole rationalization process entirely.
And the prime example in our source material for this is Acorns.
Yes, Acorns is a classic gateway.
I want to unpack how Acorns works because honestly, it practically tricks you into investing. And it does it by redefining what an investment amount even looks like.
Through the roundups.
Right. They use this feature called roundups, which really introduced the mainstream to micro-investing. Let's walk through the actual mechanics of a roundup.
Sure. So suppose you go to a local cafe, right?
Yeah.
You buy a coffee, and it costs $4.50.
Okay, $4.50.
You swipe your regular checking account debit card, the one you've linked to your Acorns app. The software sees that transaction, rounds the purchase up to the nearest whole dollar.
Which is $5.
Exactly, $5.
Right.
And then it takes that spare 50 cents from your checking account and quietly sweeps it into an investment account.
And it does this for literally everything you buy.
Everything.
You buy groceries for $41.10, it sweeps 90 cents.
All right.
You pay a streaming subscription for $14.99, it sweeps 1 penny.
Right. And the philosophy here, which echoes across all the financial guides we're looking at today, is that consistency completely overrides initial volume.
Consistency over volume. That's a great way to put it.
Because regular small contributions almost always beat irregular large ones, especially for beginners.
Well, because it operates totally beneath your threshold of financial pain.
Exactly. You don't feel the pinch in your daily budget when 50 cents disappears. You just don't.
Right. But suddenly, at the end of the month, you check the app and you're like, oh, wow, I've invested $40 or $50.
Yeah.
But let's clarify what that 50 cents is actually doing. Because it isn't just sitting in a digital piggy bank, right? Acorns is actually taking that spare change and buying fractional shares of ETFs.
Mm-hmm.
And we need to pause here and translate the jargon for a second. What is an ETF and why is Acorns using them instead of just, buying Apple or Tesla stock?
Right. So ETF stands for Exchange Traded Fund. The absolute easiest way to visualize an ETF is to just imagine a basket.
Okay, a basket.
Instead of buying one apple or one orange, which would be like buying individual stocks, you buy this pre-made basket that contains a tiny, tiny slice of hundreds or sometimes even thousands of different companies all at once.
So if one company goes bankrupt, your entire basket isn't totally ruined.
Exactly the point. It provides instant diversification. So when Acorns takes your 50 cents, it is buying a microscopic fraction of a basket that might contain pieces of Apple, Microsoft, Johnson & Johnson, and maybe some government bonds mixed in.
Man, it really is the ultimate training wheels.
It is.
But I want to push back on something here. If you only ever invest $50 a month through roundups, you are never going to become wealthy.
Right.
You aren't going to retire on spare change.
I completely agree, and that is a vital reality check. The source material is very, very clear that apps like Acorns are designed for gradual accumulation and habit formation.
Right. Habit formation.
They are not wealth generation engines on their own. They do not teach you how to analyze a company's balance sheet. Their sole purpose is to get you off the sidelines.
Yeah, to prove to your brain that the stock market isn't just some casino that instantly takes all your money.
Exactly. It builds the muscle memory of investing.
And once that muscle memory is built, though, a shift usually happens. You watch that little nest egg grow from $50 to $500 to maybe a few thousand, and suddenly those training wheels feel a bit restrictive. You start thinking about actual life goals. You want to save for a house down payment, or you want to start a real highly structured retirement fund.
And that transition brings us to the true robo-advisors, the autopilot phase.
Right. Section 2. This is where we step up to platforms like Wealthfront, Betterment, and SoFi.
Yeah, the heavy hitters of automated investing.
Let's demystify the robo in robo-advisor. Because to a total beginner, it sounds like science fiction. It sounds like you are handing your money over to a sentient AI that's, watching CNBC and day trading stocks on your behalf.
Which couldn't be further from the truth. The robo here doesn't mean artificial intelligence in the way we think of ChatGPT, where it's creatively generating ideas.
Right.
It means automated, rules-based logic. It's grounded in decades-old financial mathematics, specifically something called modern portfolio theory.
Okay, so walk us through the actual setup process. If I, download Betterment today and open an account, What actually happens?
Well, they don't ask you what stocks you want to buy. They don't ask if you think tech is going to beat healthcare this year. They ask you about your life. Like, what is this money for? When do you actually need it?
So the timeline is the master variable.
It dictates literally everything. Let's say you open 2 different accounts within the app. Account A is for your retirement in 30 years.
Okay, 30 years.
And account B is a down payment fund for a house you want to buy in exactly 5 years.
Got it.
The robo-advisor will treat those 2 pools of money entirely differently based on risk tolerance.
Let's break down that risk tolerance.
Yeah.
Because the app usually spits out a ratio, like 80-20 or 60-40. What do those numbers actually mean in the real world?
Right. So the first number is your allocation to stocks or equities. Stocks represent ownership in companies. They are the growth engine of your portfolio, but they're volatile.
Very volatile.
Yeah, they go up and down wildly based on the economy, the news, and human emotion. The second number is your allocation to bonds.
And what's a bond, simply put?
A bond is essentially a loan you make to a government or a corporation, and they pay you fixed interest. Bonds are the anchor. They are much safer, but they offer much lower growth.
So for account A, my retirement fund that I don't need for 30 years, the app might suggest an 80-20 split. 80% in stocks, 20% in bonds.
Because you have 3 decades. If the stock market crashes tomorrow and loses 20% of its value, it doesn't matter to account A.
Right, because I'm not touching it anyway.
Exactly. You have 30 years to recover. You can afford the volatility in exchange for the higher long-term growth.
But for account B, the house down payment in 5 years.
The logic completely flips. If the market crashes in year 4 and you were 80% in stocks, well, you can't buy your house.
Yeah, you're stuck.
So the robo-advisor might suggest a 60-40 split, leaning heavily into those safer bonds, or even a 40-60 split depending on how conservative you want to be.
Okay, so the app sets that target allocation.
Yeah.
And then, much like Acorns, it uses those broad, low-cost ETFs to actually build it. It buys slices of the entire global market. But the real magic of the robo-advisor isn't just setting the portfolio up on day one. It's the maintenance. It's what happens in the background while you are just, living your life.
Absolutely.
Let's bring in some specific math from the guides to make this real for the listener.
Okay, let's run a hypothetical scenario. You start with $1,000 and you set up an automatic bank transfer of $100 a month into your Wealthfront account.
Okay, $1,000 up front plus $100 on the first of every month.
Right. If we assume a historical average return of around 7%, which is the standard conservative metric used for a diversified stock and bond mix, and you just let it run without touching it, after 5 years, you end up with roughly $8,000 to $9,000.
Wow. And what did the user actually have to do to get there?
Absolutely nothing. You didn't look at a single chart. You didn't read an earnings report. But more importantly, the automated system removes human emotion from the equation.
I really want to highlight that because human emotion is the destroyer of wealth.
Oh, 100%.
When the market panics,
Yeah.
When there's a recession and the news is just screaming that the sky is falling, human instinct is to sell everything and hide the money under a mattress.
Yeah.
We stop our monthly contributions out of sheer fear.
But the robo-advisor doesn't feel fear. When the market drops 20%, the algorithm just sees that those ETFs are on sale.
Oh, that's a good way to look at it.
Yeah. It takes your $100 on the first of the month and buys more shares at a cheaper price, which lowers your average cost over time. It literally forces you to buy low, which is the golden rule of investing that humans ironically struggle to follow.
So true. Now, as these platforms compete for users, they've started heavily marketing advanced features, things like glide paths and tax loss harvesting.
Right.
These terms sound incredibly intimidating to a beginner. Can we translate them into plain English? Let's start with glide paths.
Yeah. A glide path is actually a beautiful piece of automation. Think about an airplane coming in for a landing.
Okay.
As you get closer to your financial goals, say, you are now 2 years away from buying that house instead of 5, your timeline has shrunk. You can no longer afford a sudden market crash.
Right, because you need the money soon.
The software recognizes this automatically. It starts gradually selling some of your risky stocks and buying safer bonds. It slowly changes your ratio from 60-40 to 50-50 and then to 40-60, basically gliding your money into safety as the deadline approaches.
So you don't have to remember to log in and adjust your risk. The software ages with your goal.
Precisely.
That makes perfect sense. What about tax loss harvesting? Because I know this is a feature Wealthfront built its entire early reputation on.
This one is slightly more complex, but it's a massive optimization tool. Let's say your portfolio holds two different ETFs. One tracks large U.S. companies, let's call it Fund A. The other tracks emerging markets, let's call it Fund B.
Okay, A and B.
Over a few months, Fund A has gone up in value by $500, but Fund B has lost $500.
Okay, so I am flat overall.
Yes, but the software sees an opportunity here. It automatically sells Fund B, capturing a $500 loss on paper, but it doesn't leave your portfolio unbalanced. It takes that money and instantly buys Fund C, which is a fund that is nearly identical to Fund B, but technically different enough to satisfy the IRS.
Ah, okay. Like selling your shares in Coke and immediately buying shares in Pepsi. You still own a cola company, you're still exposed to the beverage market, but you realized a loss on Coke.
That is the perfect analogy. And when tax season comes around, you can use that $500 paper loss from Coke to offset the taxes you might owe on the gains from Fund A, or even use it against your regular income. And the algorithm does this continuously in the background, harvesting these microscopic tax advantages all year long.
Okay, I have to step in here and play the skeptical listener for a minute.
Go for it.
Because this all sounds incredibly slick. It sounds highly efficient. But as a beginner, handing over the keys to my entire life savings to a line of code is genuinely terrifying. What happens if there's a glitch? What if the algorithm hallucinates, like we talk about at the top of the show, and decides to sell all my Apple stock and dump my retirement fund into some bankrupt penny stock?
It is a totally valid fear, but again, it fundamentally misunderstands the architecture of a robo-advisor. These are not generative AI models. They're not thinking or predicting. They are rigid, mathematically tethered rules engines.
Meaning what, practically?
If you set your risk tolerance to 80-20, the system physically cannot wake up and decide to go 100% to crypto. It simply runs math equations to maintain that 80-20 balance.
So it's less like a chatbot and more like a very sophisticated thermostat.
Exactly.
You set it to 72 degrees. If the house gets cold, it turns on the heat. If it gets hot, it turns on the AC. It isn't going to suddenly decide the house should be a sauna.
That's exactly right. And even at the highest institutional levels, humans are still watching the thermostats. The source materials actually point to a fascinating example of this. Charlotte Street Capital.
Right. The prompt notes that even the world's most profitable hedge fund keeps humans in the loop.
They absolutely do. They are known for running some of the most sophisticated, profitable algorithmic trading systems in the entire hedge fund world. They have AI systems processing millions of data points, executing trades at light speed, doing things a human brain could never keep up with. But Charlotte Street Capital maintains a strict policy. Human oversight is always present. Always. The AI is monitored to ensure it doesn't drift from its core parameters or react bizarrely to unprecedented market shocks.
Right, because things happen that the AI has never seen before.
Exactly. If a multi-billion-dollar hedge fund won't let an algorithm run entirely unsupervised, you can be assured that the consumer-facing robo-advisors have massive human compliance teams monitoring the aggregate code.
That is reassuring. The guardrails are bolted to the floor. But this brings us to a major transition point for the listener.
Okay.
What if you want to take the guardrails off? What if you're tired of the closed track? You don't want a perfectly diversified, slightly boring portfolio. You want to pick specific stocks, you want to try and beat the market, but you don't have 40 hours a week to read spreadsheets.
Then you were stepping out of the automated robo-advisor world and entering the realm of the AI co-pilot. You want the GPS system.
Section 3. The AI co-pilot. And according to our sources at Barebone Research, this landscape immediately fractures into two distinct categories: research platforms and signal tools. Let's tackle the research platforms first. I call these the investigators.
A research platform is basically designed to help you build and investigate an investment thesis. It pulls together fundamental data, technical indicators, market sentiment, and ownership data, allowing you to interrogate the market way faster than you ever could manually.
The standard example in the research material is Barebone AI. And the pedigree behind this platform is wild. The test data notes it was built by a former Goldman Sachs investment banker teaming up with a former Hanson robotics engineer.
Yeah, so you have Wall Street financial modeling colliding with high-level artificial intelligence architecture, and it really shows in the feature set.
Right.
Barebone AI offers over 20 specialized skills designed for mobile-first users, but the two that stand out the most are its ability to track insider trades via SEC Form 4s and its ability to track super investor holdings via 13F filings.
Okay, let's pause. Jargon check. Because these are two concepts that sound like they belong in a corporate law textbook, but they are incredibly powerful for retail investors. What is an SEC Form 4?
The Securities and Exchange Commission requires corporate insiders, so CEOs, CFOs, board members, to publicly disclose when they buy or sell shares of their own company. That official disclosure is a Form 4.
So if the CEO of Ford buys $1 million worth of Ford stock, he has to tell the world.
Yes. And as the old Wall Street adage goes, insiders might sell their stock for a dozen different reasons. They're buying a yacht, they're paying for a divorce, they're just diversifying their assets. But they only buy their own stock for one reason. They think the price is going to go up.
They know the menu better than anyone else. It's like seeing the head chef sit down and eat his own restaurant's special.
Precisely. But historically, for a normal person to track Form 4s, you had to dig through the clunky SEC website, read these dense legal filings, and manually track the dates. It was a nightmare.
Barebone AI automates this.
Totally automates it. It reads the filings the second they drop and translates them into a simple feed. You can literally ask the AI, which tech CEOs bought more than $500,000 of their own stock this week?
That's incredible. And what about the 13F filings?
13F is a quarterly report filed by institutional investment managers with over $100 million in qualifying assets. Basically, the billionaires,
Like Warren Buffett?
Warren Buffett, Ray Dalio, Bill Ackman, 4 times a year, they are required by law to show the public exactly what stocks they are holding in their massive portfolios.
So I can literally look at exactly what Warren Buffett is buying.
You can, but there is a catch that the AI helps navigate. 13Fs are delayed by up to 45 days after the end of the quarter. So by the time you see what the billionaire bought, the information is stale. The price has probably already moved.
So how does the AI help?
Barebone AI helps synthesize this data, looking for aggregate trends across dozens of billionaires to see if smart money is quietly accumulating a specific sector rather than just you copying a single stale trade from one guy.
But this brings us back to the giant red flag we raised at the very beginning of the deep dive, the 35% hallucination rate.
Right.
If Barebone AI is reading legal filings and financial data, how do we know it isn't just, making up the fact that a CEO bought stock?
Because of how its architecture differs from a standard text generator. A general chatbot uses statistical probability to guess what word should come next in a sentence. It doesn't actually know the math.
Okay.
Barebone AI, according to the research, uses a system that forces the AI to verify its outputs against underlying structured financial databases before it displays anything to the user.
So it's checking its own homework against a hard-coded answer key.
Yes, exactly. It limits the creative generation in favor of strict data retrieval. Now, it's vital to note that Barebone is an investigator, not an executor.
Meaning it won't buy the stock for you.
Right. It does not connect to your brokerage. It gives you the research, and you have to go log into Fidelity or Robinhood and execute the trade yourself.
Got it. Now, if you are not a mobile-first user, if you're the kind of person who loves sitting at a desktop, staring at massive tables of data, and you really want to get into the plumbing of a company, the sources point to Fiscal.ai.
Fiscal.ai is described as the haven for fundamentals nerds.
Quick break. If you're enjoying all things investing, be sure to follow, rate, and share this episode with a friend who needs to start investing smarter. Got questions? We might answer them in the next episode. Now, back to the show.
Unpack fundamentals for us. What are we actually looking at here?
Fundamental analysis is the process of evaluating a company's intrinsic value by examining its financial statements. It's looking under the hood of the car.
Like revenue and profit.
Exactly. You're looking at revenue, profit margins, cash flow, debt loads, and metrics like the PE ratio or price-to-earnings ratio. Fiscal.ai gives you access to over 20 years of this historical financial data for companies.
So if I want to know if a company has historically survived high interest rate environments by looking at their debt load way back in 2006, Fiscal.ai provides that depth.
It does. But the sources note it has almost no technical analysis.
And that is a crucial distinction. What's the difference?
Fundamental analysis looks at the business. Technical analysis looks at the stock chart. Technicals don't care what the company sells. They care about price momentum, trading volume, and psychological patterns in the chart itself. Fiscal.ai ignores the chart to focus entirely on the business data.
Okay, good to know. And briefly, the sources also mention Magnify, which they describe as the ChatGPT of investing, for around $14 a month.
Magnify's real superpower is cross-account visibility. It actually syncs directly with your brokerages.
Oh, that's cool.
Yeah, so you can ask it plain English questions like, how much total exposure do I have to the energy sector across my Robinhood and my Vanguard accounts?
That's super useful.
The depth of fundamental analysis isn't as profound as Fiscal.ai, obviously, but the conversational interface and account syncing make it a very, very friendly overview tool.
So those are the research platforms, the investigators. You use them to build a case. But what if you don't want to build a case?
Right.
What if you still want the GPS to just tell you exactly where to turn? That brings us to the other half of the Copilot landscape. Signal tools, the shortcuts.
Signal tools compress all that massive, complex data into a simple output. A flag, a daily pick, a 1 to 10 score, a probability metric. They do the math and then just hand you the result.
Danelfin is one of the platforms. The sources rank highly in this category. It basically evaluates thousands of stocks and gives them a score from 1 to 10 based on AI-assessed probability of that stock beating the market over the next 3 months. But what I find fascinating about Danelfin is its commitment to explainable AI.
Oh, explainability is the antidote to the black box problem.
What's the black box problem?
A lot of signal tools operate as a black box, meaning data goes in, a buy rating comes out, and you have absolutely no idea what happened in the middle. The algorithm expects you to just trust it blindly. Danelfin actually shows you its work.
So if he gives a stock a 9 out of 10, I can see exactly why.
Yes. It will show you the feature breakdown. It might say this score is being driven 50% by strong fundamental cash flow, 30% by positive technical momentum on the chart, and 20% by positive social media sentiment.
I love that. And for listeners looking for free options, the sources give a shout out to Prospero.ai.
Yeah, Prospero offers institutional-style signals at zero cost, although the explanations are a bit more limited than Danelfin's.
But we have to stop here and address the severe danger of signal tools.
Definitely.
Let's go back to our car analogies.
Yeah.
I think using a signal tool without doing your own research is like staring at the check engine light on your dashboard.
That's exactly what it is.
The light tells you exactly where to look. It says, hey, something significant is happening under the hood here. But the light doesn't fix the car. A signal is a starting point for your attention. It is not a complete bulletproof investment thesis.
That is the perfect way to contextualize it. The most catastrophic, expensive mistakes I see beginners make happen when they trade blindly on signals they do not fundamentally understand.
Just following the light.
Yes. If Danelfin or Prospero says, buy stock X because momentum is high, and you dump $10,000 into it without even knowing what product that company sells, you are not investing. You are gambling.
Because if the momentum suddenly reverses, you have no conviction to hold the stock. You panic and sell for a loss.
Exactly. Signals are shortcuts for your attention. They highlight the needle in the haystack, but you still have to verify that the needle is actually worth buying.
So we've gone from the passive, closed-track autopilot of robo-advisors to the hands-on GPS co-pilots of research and signal tools. But just to show the full spectrum of what is out there, let's briefly touch on Section 4. The extreme end of the spectrum.
Right, the active trading tech.
The tools built for active, everyday day traders.
This is where the technology stops being a helpful co-pilot and starts looking like the cockpit of a fighter jet. The complexity scales up exponentially.
We're looking at platforms like TrendSpider. This starts at around $54 a month, and its entire job is automating technical analysis.
We mentioned technical analysis earlier, reading the stock chart rather than the business fundamentals. TrendSpider basically takes the human error out of chart reading.
How so? Because honestly, drawing lines on a chart always looked a bit like astrology to me.
It can definitely feel that way. Technical traders look for support and resistance lines. Simply put, a support line is a price level where a stock historically stops falling because buyers step in.
Okay.
And resistance is a price level where it historically stops rising because sellers take over. Finding these lines manually across different time frames, like the 5-minute chart, the hourly chart, the daily chart, is exhausting.
I can imagine.
TrendSpider's algorithms instantly detect and draw these trend lines across multiple time frames simultaneously, and then they set dynamic alerts.
So it sends a push notification when the stock price crosses one of these invisible psychological barriers.
Exactly.
That is powerful automation if charts are your edge. But if you are already a seasoned technical trader, staring at TrendSpider is going to look like the Matrix.
It will be entirely meaningless. And then you have platforms that go even further, like Trade Ideas.
Yeah, Trade Ideas is the veteran heavyweight in the AI scanning space. They feature an AI named Holly. The sources note that Holly runs dozens of quantitative strategies overnight, backtesting them against historical data, and then spits out live trading setups during market hours.
Yes.
But this level of firepower comes with a massive price tag. We are talking anywhere from $1,000 to over $2,000 a year.
Let's unpack what it means to run strategies overnight and evaluate a live setup. Holly is looking for micro anomalies. For instance, a stock that usually trades 1 million shares a day suddenly trades 5 million shares in the first 10 minutes of the market opening.
Wow, okay.
While simultaneously breaking above a specific technical resistance line, Holly recognizes that pattern, calculates the statistical probability of the stock continuing to run based on decades of historical data, and pings the day trader to buy instantly.
It requires you to be sitting at your desk, finger hovering over the mouse, ready to execute within seconds.
Yes. And here is the harsh reality check for the listener. These tools are total overkill for 99% of investors.
100% agree.
If your goal is to grow your wealth steadily for a house or for retirement, you do not need a live scanner firing off momentum alerts at 9:31 a.m. You need discipline, broad market exposure, and patience.
Right.
Day trading is a zero-sum professional discipline. You are competing against supercomputers and Wall Street firms.
Which perfectly sets up our transition into Section 5.
Oh, okay.
If day trading is way too intense and expensive, and robo-advisors feel a bit too passive because you genuinely want to be involved in the strategy, is there a middle ground? Can you leverage human expertise, proven track records, and AI technology all at once?
You can. And this brings us to one of the most disruptive developments in the current landscape, AI-assisted social investing.
I am fascinated by this model.
Yeah.
Let's dive into the platform Dub and also eToro, because according to their materials, this represents a fundamental paradigm shift in how retail investors approach the market. It literally changes the foundational question of investing.
It really does. Historically, the question every single retail investor asks when they open a brokerage app is, which stock should I buy?
Right. What's the hot tip?
Exactly. The social investing model changes the question to, which investor should I invest alongside?
You stop trying to pick the winning horse and you start trying to pick the winning jockey.
Exactly. You are outsourcing the asset selection to someone with a proven, verifiable track record, but you are retaining control of your own capital. And this model is democratizing a world that has historically been heavily gated.
Let's talk about those gates.
Yeah.
Because normally if I want to invest alongside a big hedge fund manager or a highly successful registered investment advisor, an RIA, I face massive regulatory and financial hurdles.
You usually have to qualify as an accredited investor. This is an SEC designation under Rule 501 of Regulation D.
Which means what in dollars?
To be accredited, you generally need to have a net worth of over $1 million, excluding your primary residence, or a sustained income of over $200,000 a year.
It is the ultimate VIP room of Wall Street.
It is.
The logic from the SEC has always been that these private funds are riskier and less regulated, so only wealthy people can afford to take the hit if things go south.
That's the paternalistic view of the regulation, yes. But even if you meet that high bar and get accredited, the minimum deposit to actually get into one of these hedge funds is often $1 million or more just to open the account.
So the average person is completely locked out.
Completely.
But the sources note that on platforms like Dub, through their Advisors Creator program, retail investors can essentially mirror the portfolios of these exact same RIAs and hedge fund managers starting at a $100 deposit.
Yeah, and eToro operates on a similar philosophy with their copy trader feature, allowing users to automatically copy the moves of top-performing investors on their network.
I want to clarify something for the listener, though, because the idea of copying someone else's homework usually feels like a cheat code, or maybe something slightly illicit.
It is not a cheat. And it is a completely legitimate learning strategy for beginners. In fact, it's basically the digital equivalent of an apprenticeship.
An apprenticeship, I like that.
You aren't just trusting an opaque black box algorithmic model. You are watching real, verified human experts work in real time. You see when they buy, you see when they rotate out of a sector, and you learn from their execution.
But this deep dive is about AI. If human experts are making the trades, and I am copying the human experts, where does the artificial intelligence actually come in? What is the software doing?
On a platform like Dub, the AI enhances the discovery and understanding process. Think about the friction of this model. If you're a beginner trying to evaluate a professional's portfolio, the amount of data on their profile is staggering.
Oh, yeah.
You are looking at 50 different holdings, historical performance charts, risk metrics, sector weightings. It is overwhelming.
So Dub uses features they call AI chips to cut through that noise.
Right. The portfolio summary chip, for example, uses a large language model to read the complex strategy, analyze the holdings and the performance data, and instantly rate a quick, plain English overview.
Wow, so it translates it.
It translates the quantitative data into a qualitative narrative that a beginner can digest in 30 seconds. It explains why the portfolio is built the way it is.
And then there is the personalized portfolio fit chip. I find this one brilliant because it addresses a major blind spot for beginners: portfolio overlap.
The diversification problem.
Right. Let's say you already own a ton of tech stocks in your personal account. You log on at a Dub, you see a hedge fund manager with a phenomenal return rate, and you decide to copy them. What you might not realize is that their portfolio is also 90% tech stocks.
So by copying them, you haven't diversified at all. You've just doubled down on your existing risk.
Yeah. If the tech sector tanks, you take a massive hit on both sides.
The personalized portfolio Fit.ai assesses how a pro's portfolio aligns with your existing outside exposure and your stated risk score. It acts as a guardrail, warning you if copying a specific creator would dangerously unbalance your overall financial picture.
They're also rolling out a beta AI assistant named Arlo, which takes this a step further by allowing you to use plain language searches to find the right jockey.
Instead of clicking through endless filters and drop-down menus, you can simply type to Arlo, "Find me a portfolio managed by someone with a 5-year track record that specifically avoids concentrating in the tech sector and has low volatility."
And Arlo just parses the database and serves up the best matches.
Exactly.
Now, the key here, and the sources are very explicit about this because of regulatory compliance, is maintaining control. In the social investing model, the AI does not trade for you, and Arlo, the chatbot, does not execute trades on its own.
You are using regulated brokerage services. These platforms use members of FINRA and SIPC.
Let's do another quick jargon check on FINRA and SIPC because beginners see those acronyms on literally every financial website and usually ignore them. What do they actually mean?
FINRA is the Financial Industry Regulatory Authority. They monitor the brokers to ensure they're operating ethically and following the rules.
Okay, and SIPC?
SIPC is the Securities Investor Protection Corporation. It provides insurance for your account, but, and this is a critical distinction, SIPC protects you if the brokerage firm itself goes bankrupt and loses your money.
Right.
It does not protect you against market losses if the stocks you buy go down in value.
Important clarification. So, you are in a regulated environment and you retain full copy controls. You can allocate more money to the copied portfolio, you can liquidate your position entirely, or you can sever the connection and stop copying a creator at any given second.
You are never locked in. The copied portfolio acts as a second, highly informed perspective. It is a tool to leverage expertise, not a hostage situation for your capital.
All right, we have talked about some incredible, genuinely empowering tools today. The automatic wealth building of robo-advisors, the analytical depth of research assistance, the democratization of social copying. It sounds utopian,
Right.
but we need to pivot to Section 6, the hidden risks, because the sources are very clear that beginners, dazzled by the AI marketing, are stepping into traps they do not see coming.
The first major trap is the black box warning, which stems from an over-reliance on AI signaling and a fundamental misunderstanding of how AI models are actually built.
The sources single out a platform called Tickeron as an example of where things get precarious. Tickeron offers a massive, complex menu of AI bots, pattern recognition engines, trend forecasters, specialized crypto bots,
Right.
and they charge anywhere from $60 to $250 a month for access. But the source issues a very strong warning about what they call win rate marketing.
Yes. Whenever you see a platform aggressively marketing its AI's win rate, saying things like, "Our algorithm has an 85% success rate over the last 5 years," you need to apply intense, cynical skepticism.
Because that 85% win rate is almost always based on a backtest.
Exactly. Let's explain backtesting and the extreme danger of overfitting. Backtesting is taking a set of rules and applying them to historical market data to see how they would have performed. The problem is that AI is incredibly good at curve fitting.
What does curve fitting mean in this context?
Imagine hiring a tailor to make you a suit, but the tailor designs the suit while you are standing perfectly still holding one very specific awkward pose.
Okay.
The suit looks flawless while you're in that pose, but the second you try to walk or sit down or just live your life, The suit rips apart because it was only engineered for one highly specific past scenario.
That is a brilliant analogy. So the AI looks at the market data from 2018 to 2023, and it adjusts its own rules over and over again until it creates a mathematical model that perfectly predicts every dip and spike that already happened.
Yes. It creates a model that has an 85% win rate in the past. That is overfitting.
Wow.
But the market tomorrow is never exactly the same as the market yesterday. An overfitted AI model will look like an absolute genius in a backtest and then completely collapse in live forward-facing trading because it cannot adapt to new, unprecedented variables.
Which brings us back to the core truth. AI's real value in investing today is automating tedious work, synthesizing vast amounts of data, and making your research phase faster. It's not a crystal ball.
It's not.
There is zero reliable, peer-reviewed evidence that consumer AI consistently beats the market or predicts future winners. If an app implies guaranteed returns, run the other way.
The second trap, and arguably the more insidious one because it is entirely legal and completely transparent, is the compounding cost of fees.
Oh, this is so important. Let's break down the math of small fees, because it is legitimately shocking when you map it out over a lifetime.
Most robo-advisors and managed platforms charge a management fee typically around 0.25% to 0.50% annually, and that is on top of the expense ratios of the underlying ETFs they buy for you, which might be another 0.05% to 0.20%.
Okay, let's look at the math. Let's say your total all-in fee for the platform and the funds is BICE or 0.40% a year.
Okay.
If you invest $1,000, 0.40% of that is $4. You are paying $4 a year for an automated wealth management system.
Which sounds like absolutely nothing.
I spend more than that on a single cup of coffee.
In year one, it feels invisible. It is completely frictionless. But remember, the entire goal of investing is compounding growth over decades.
Right.
As your portfolio grows to $50,000 or $100,000 or $500,000, that percentage fee grows right alongside it. And the money you pay in fees is money that is no longer in your account compounding for your future.
Over 30 years, the difference between paying a 0.40% fee and a 0.10% fee isn't just a few bucks. It can mean tens of thousands of dollars completely missing from your final retirement balance. The fees silently eat away a massive portion of the final returns.
Which is why transparency in pricing is critical. The sources highlight Dubb's pricing structure as an interesting example of trying to balance this. They charge a flat $9.99 a month subscription, plus an asset-based management fee of 0% to 2.5% for their premium portfolios.
Okay, I am going to jump in here and act on behalf of the highly skeptical listener.
Go for it.
Because if I am paying for a software platform, and the AI or the algorithm is doing all the automated work in the background, why on earth am I paying a percentage of my total wealth instead of just a flat software fee?
That's a fair question.
Feels like a wealth tax. Managing $100,000 in a database doesn't take 10 times more computing power than managing $10,000. So why does the fee multiply by 10?
That is a very aggressive, very valid pushback, and it gets to the very heart of how Wall Street pricing models are constructed. The model you're challenging is called the AUM model, assets under management. Charging a percentage of your wealth is the traditional, deeply entrenched standard of the financial industry.
But what is the justification for it, beyond just, that's how we've always done it?
The argument for the AUM model is incentive alignment. The theory goes, if I charge you a flat $10 a month, I don't really care if your portfolio grows or shrinks because I get my $10 either way.
Okay.
But if I charge you 1% of your assets, I make more money when your portfolio grows, and I take a pay cut if your portfolio shrinks. Therefore, my incentives are perfectly aligned with yours. I'm highly motivated to grow your wealth.
I see the logic, but as you said earlier, the software isn't really actively working harder to grow the 100,000 than the 10,000.
Precisely. The counter-argument is exactly what you just laid out. It is software execution, not bespoke human advising, which is why listeners need to watch those percentages like a hawk.
Because they compound.
Yes. A 1 or 2% fee sounds minuscule when you sign up, but it is a massive drag on a portfolio over a lifetime. Whether you choose a flat fee subscription, a free tier, or an AUM model, you have to run the math.
We really do.
You need to ensure that the value you are getting, whether that's access to elite hedge fund managers, tax loss harvesting that saves you thousands, or proprietary research data, is actually mathematically worth the drag on your returns.
So we have covered a massive amount of ground today, from the behavioral psychology of the starting line to the mechanics of modern portfolio theory to the depths of SEC filings to the democratization of social trading and the dangers of curve-fitted AI models.
It's a lot.
It is. How do we synthesize all this advice into a practical framework? If a listener is sitting in their car right now or walking their dog and they want to start today, what is the action plan based on these sources?
Let's lay out a 3-step, 24-hour map. It is about building what we call a core and explore model. Step 1. Write down a specific goal and a concrete timeline, literally one sentence. Is this money for retirement in 30 years or a house deposit in 5 years? The timeline dictates the risk, and the risk dictates the tool.
Step 2.
Step 2. Build the core. Start with a robo-advisor like Wealthfront, Betterment, or even Acorns if you need the psychological trick of roundups. Open the app, link your bank account, and set an automatic monthly transfer, even if it is just $50 a month.
Just automate it.
The critical part of step 2 is committing to let this run for at least 6 months without touching it, without checking it every day, and without reacting to the news. Let the automated habit form. This becomes the stable, boring, compounding engine of your financial life.
Step 3.
Step 3, the Explore Fund. Once your core is automated and running quietly in the background, you can set aside a smaller pool of money you are entirely comfortable taking more risk with. Use this to actively learn about the market. Use an AI research tool like Barebone AI to investigate fundamental data, or a social platform like Dub to track how real professionals manage risk. Interrogate the data, understand the why behind market movements, and start taking the wheel yourself.
And that leads to the golden rule of this entire deep dive.
Yeah.
The one sentence you should take away from this show. Never let any app, any algorithm, or any signal make a financial decision that you do not fundamentally understand.
Hands-off investing does not mean no responsibility.
Absolutely. AI investing apps are genuinely revolutionary tools. They really level the playing field, giving retail investors data processing power that used to cost Wall Street firms millions of dollars to build. But they work best when the human investor stays engaged. You remain the pilot. The AI is simply the navigation system.
The barriers to entry have never been lower. The tools are there, the data is transparent, and the friction is gone. It just requires that first step.
But before we sign off, I want to leave you with a final, lingering question to ponder on your own.
Oh, I like this one.
We talked about how these tools are democratizing access. But as these AI research platforms and signal tools become ubiquitous and exponentially more advanced, what happens when every single retail investor and every major Wall Street firm is using the exact same super intelligent AI model to predict the market?
It's a fascinating, almost existential thought experiment for the financial world.
Right. Because if everyone's AI knows the optimal move at the exact same millisecond, does the stock market just become a perfectly flat stalemate?
A massive digital gridlock.
Yeah, where nobody can actually beat the average because the AI effectively becomes the average.
An edge in the market is only an edge until everyone else has it. Once the technology is universal, the only variable left is human discipline.
Something to think about the next time an app promises to give you an exclusive, unbeatable edge. Thank you so much for joining us on this deep dive. Take that first small step today, set your goals, watch those fees, and let the tech work for you. We'll catch you on the next one.
Thanks for tuning in to All Things Investing. Don't forget to subscribe so you never miss a tip that could boost your financial future. Follow us on TikTok, YouTube, and wherever you get your money advice. Until next time, keep investing in yourself. Financial disclaimer. The information provided on the All Things Investing podcast is for educational and informational purposes only. It is not intended as financial, investment, tax, or legal advice. Always do your own research and consult with a licensed financial advisor or other qualified professional before making any investment decisions. The views and opinions expressed are those of the host and guests, and do not constitute official recommendations. Investing involves risk, including the potential loss of principal. Past performance is not indicative of future results. By listening to this podcast, you agree that the host and associated parties are not responsible for any financial decisions you make based on the content provided.